welcome to Global Market Outlook 2016, a special series that we bring to you each year from the City of London, talking to prominent fund managers and market speakers about their outlook into the new year. Joining me today on the show is Lucy MacDonald, CIO at Allianz Global Investors. Lucy, it's great to have you. This is your first interview to an Indian business channel, so great to have you on the show. Let's start off with your broad outlook into 2016. 2015 has been patchy. It's been very differentiated in terms of individual markets doing well. How are you positioning yourself for 2016?
Our expectation into 2016 is that we are going to have lower returns across many asset classes and also more volatility. And we've come off a period where you've had very strong returns and quite low volatility. That we think is going to change and has already begun to change in currencies and now in equity markets as well. And so we think it's going to be a more challenging environment. It's not going to be an environment in which one can just buy an index fund and expect to do well. It's going to be one where you're going to need to be a lot more selective and active.
Right, but in your broad view, as CIO Equities at Allianz, where is it that you would be allocating capital?
We still think there's more value outside the US than in the US. So although overall it looks as if returns are going to be quite muted, there does look to be a bit more potential upside in some of those markets. And that does include the emerging markets as well. So I think those are the areas where we're looking to see some more upside as we go into the next year.
Let's talk about US equities first. Now, this year has been a record year despite all the uncertainty with the Fed rate hike and where the economy is headed, the data there being also a bit all over the place and a bit uncertain, so to speak. Most people believe that, yes, the US economy is on a strong footing. Recovery is pretty much the way forward. However, the data has gone a bit back and forth. Do you believe that US equities will continue to outperform into 2016? Will they continue to trade with a positive bias because there are record levels this year?
Yeah, valuations, starting levels are quite high for US. So that does mean it's going to be harder work to make any absolute return. And one has to be a lot more selective as well. The underlying economic momentum, as we know, is a little bit patchy. And overall, across the developed world, you're not seeing a huge amount of positive economic momentum. So you've got slow growth, which we think will continue because of the level of debt in the system. And then you've also got pretty unimpressive momentum. So that means that companies are going to find it hard work to grow their top line. And that we've seen throughout the year, but particularly in the last corporate season in the US, you've seen revenue missing across the board, but margins making it up, and also share buybacks. And so earnings overall have slightly outperformed, but it's finding revenue, and that's where finding growth is going to be the most important thing. So where can you find that? Either in industries or in regions. That's going to be really the big determinant of relative performance, we think.
But a large part of the rally has also been led by the technology sector. You think that it's a bit polarized in the US, so you'll see the broad markets, the broad benchmark indices seeing limited upside, but the NASDAQ, the technology-oriented sector, will continue to draw the interest that it did this year?
Yes, I think there's still more interest and growth, as we said, in technology. But also healthcare has done very well, consumer discretionary has done very well, and those have been really the leading sectors over the last couple of years. And technology has got some good structural growth drivers in there. So whether that's internet or mobile or Internet of Things, there's plenty of structural growth there, and that is something that we as equity investors are looking for. So yes, I think that will still continue to be the case. However, some of those areas, and certainly the more sort of conceptual areas, are looking a little bit more expensive. So I think, again, you have to be very selective. You can't just buy the whole index in technology. You have to find the stocks.
Okay, the oversold trade for 2015 has been emerging markets. Given the currency mayhem and the sell-off there, would that be a strong point where we would see a reversal? Not just in the currency fall, but also the way some of the emerging markets have fallen this year. Do you think that they would be in for a rebound, one led by technicals, then followed by fundamentals?
It's going to be differentiated, I think, between the commodity producers and users again, and that's really what we've seen. So with commodity prices and energy doing what it's done over the last year, that has been a big differentiator. And so I think when you look at some of the the oil producing areas within emerging, it's going to depend on that commodity. But China has really got something else, with its own driving its own growth from internally. So I think you've got to be selective again and differentiate between the different countries within emerging.
It's been a dramatic year for China. Do you think that'll change, especially with the inclusion of the yuan in the SDR?
Well, we don't know that yet. We're assuming that will happen.
Yeah.
But it has been quite a dramatic year for China. And I think the focus on the currency going forward, if it does indeed get into the SDR, it will really gain some more credibility within financial markets. So I think it will again be very important what happens in China, and that's going to be the case just because of the size of the economy and the fact that it is becoming more integrated with the rest of the world as an economy, but also in markets too. And so you can see that already, higher correlations within markets with what's happening in China, whereas previously the Chinese stock market was seen a very sort of selective, slightly casino-like. It's actually beginning to have a bigger impact.
Do you think the fear about China has been overdone, and that would perhaps reverse, if the yuan were to devalue from here further or depreciate, whichever way you look at it from here further, that would be seen as an opportunity given the reserves that China has, given its dominance, being touted as a global growth engine, that would reverse, and that would perhaps also be a trigger to look at Chinese equities favorably. So, that would perhaps also help in lifting all boats across Asia, so all other markets will do well too in view of that.
Well, I think any movement in the RMB is going to be very carefully watched, and particularly anything that's looked like an uncontrolled devaluation and a devaluation of any size, I think could cause quite a lot of volatility. And initially, whatever its impact will be later on. So I think that is a source of volatility, which we're looking to into next year. But within China, again, you've got a big differentiation between the old and the new. And so some of the newer areas, technology, the social networking companies, some of the consumer companies are doing okay. And we've heard from Apple as well, of their sales seem to be holding up. So there's still, within the consumer and the service areas in China, there seems to be more strength. And that is both from the top down and the bottom up. There's more strength there. Whereas the big consolidation and industry restructuring is happening in the old economy. So in the areas like in the steel sector. There is going to be a big difference in where you're invested and your outcomes.
But given the headlines that China made this year, starting off with the sell-off in commodities and then the yuan devaluation, the PBOC stimulating the economy with a series of rate cuts as well as cuts in the reserve ratio, do you see all of that coming to work in 2016, wherein, we've seen all the bad news perhaps play out, or the not so positive news, let's not say bad news, but the not so positive news being put out there and priced in, and so things only get better from here for China, and the fear of China getting into a zone of hard landing perhaps seem overdone in hindsight?
I think the worst fears of hard landing, we've probably seen them for the moment, but what China is going through is a long-term process of rebalancing and restructuring. So it's not all going to suddenly turn around in a year. It is a long process, and I think you're talking about a very complicated trying to rebalance the economy from the fixed asset investment into consumption services. That's one thing. At the same time, trying to liberalise the financial account and trying to maintain reform within the funding in the local regions. All of that is an extremely complicated thing to do when you've got the level of debt that's been built up by the recovery from the last financial crisis. So I think it's a process which is going to take a long time to move through, and in that time you will get quite confusing numbers coming from the macro. But that doesn't mean that within that you can't invest, because as I said, there are many sectors of the economy which are more divorced from that.
But you think all the bad news from China is out? I mean, whatever we could hear...
No, I don't think necessarily it is.
Okay.
But I think certainly as far as has been priced into shares for the moment, as far as what we know, it probably is priced in.
Would you be more bullish on Chinese equities into 2016 than you were in 2015?
Well, we weren't at all positive in 2015, so yes, we probably would be. And we're certainly looking, and have been in the recent weakness, in August looking to add to some of the positions of companies which have exposure there. So I think we're more on the positive tack in China, but I do think the overall backdrop is going to take a long time before we're getting positive momentum again.
How are you comparing the India story? I know the debate has been endless on India versus China. Sometimes perhaps not even that fair given the scale of the economies. But from an equity market perspective, how do you see the India story? Within the Asia Pac, where do we go from here for India?
Well, the difference clearly with India is that you have two very strong domestic drivers. One with the reform, and the second with what the central bank has been doing. So those are very strong domestic drivers, and they have been the biggest drivers of the revaluation of the market. But also at the same time, you've had some help from lower oil price. And I think also an environment where there was concern about China, and therefore investors felt more comfortable with India. And so the question is any of that going to change into next year? And the concern, obviously, at the moment is about the pace of reform, and that is a big part of enthusiasm of international investors towards India is reform. So that is going to be very carefully watched to see whether that begins to slow down as a result of the political situation. And then the liquidity environment and the interest rate environment still seems positive, so that's good. Then on the external side, oil prices, we can't forecast, but do we think that we've probably seen the bottoming out situation there? Probably, because of the level of pain that's been felt by the protagonist of the supply shock, i.e. Saudi Arabia. So you're probably in a bottoming process as far as that's concerned. And then as far as China, if China stabilises, then maybe you won't get such a pullback. So I think it's a mixed picture going forward, and valuations within India are expensive within an emerging context, and in some areas where international investors are particularly keen, so some of the consumer sectors, healthcare and technology, they're very expensive. So that, I think, will probably hold enthusiasm back to some extent, and positioning is very positive. So I think there's huge opportunity there. There's enormous growth potential.
Would you be looking to allocate more to India in 2016? Do you think the environment seems favourable at this point to invest more in India?
I think we'd certainly like to see a little bit more value in those areas where we can see direct comparisons between the companies and global companies. Because at the moment, as I said, because there's a sort of scarcity premium in those stocks, it doesn't look obvious that you would want to be invested in them directly rather than have some indirect exposure into India. So I think there'd still be nice to see a bit more value to get really keen and really bullish about it. And at the same time, there are a few more question marks about that, the big driver of bullishness, which is reform. So I think a little bit more caution at the moment, just on those two factors.
But when you say value in India, do you think that maybe 5% lower from here would be a reasonable time? Because in terms of valuations, we are pretty much in that range of our historical average for the benchmark index, at between 14 to 18 times roughly. And if that's the case, then maybe perhaps 5% down from here would make India more compelling than it
would certainly, but I think within that 16 you've got some areas like energy utilities which are on 10, and then you've got consumers and healthcare on 30. So and those are the sectors and the companies that we as bottom-up investors are probably more likely to be interested in investing in rather than necessarily in the energy and the utilities. So I think that's the factor.
Corporate earnings in India have lagged, and that's a story globally. You highlighted the fact that the top line is not improving. It's really been a margin and an EPS-driven story. How long can that story go forward? Because we've seen in the earnings so far as well in India that demand is not coming back in. The top line sales growth is not kicking in. So how long can margin expansion, thanks to commodity prices, drive earnings into the new year as well?
Well, in global markets, in the US, the margin expansion has been very strong. And so it becomes more difficult to keep that going when you have wages beginning to rise and also interest rates rising even a little, because the low interest rates have been a big spur to margins in the US. So I think the US, it becomes more difficult. In Europe, there is more scope for margin because the margins are still lower than they were pre-financial crisis. So I think there is scope there. And emerging markets, there is scope too. But we all know it really helps to get a bit of top-line growth. But you're not going to get that really from global growth as a whole. We're talking about 2.5 to 3 on volume, with maybe another 1% on price. It's going to be hard work to really get some operational gearing off that. Now in India, you've got a lot more on the top line. You've got double that on the top line to start off with, and a little bit more on inflation. And so that must be a help as far as getting margins through, as long as it continues to go, and it looks as if it will. If the reform is seen to be continuing, that is, I cannot overemphasize how important that is for international investors. They really like that, to see that change coming through, so that the supply constraints to growth in India are being addressed, and infrastructure being a big one of those, but also the creation of an internal market, which the tax reform will do. So those things are seen as extremely important for international investors.
You expect earnings to kick in maybe 2 quarters down the line in India?
The momentum is still slightly negative, but if the top line continues, then there is still better growth in India than there is elsewhere in the world.
Okay, and what about markets? You said that there's going to be, if there's value, then you would allocate more to the Indian market. Do you think that India would continue to be perhaps the strongest story in emerging markets into 2016?
If the reform is seen to be continuing, that is, I cannot overemphasize how important that is for international investors. They really like that, to see that change coming through, so that the supply constraints to growth in India are being addressed, and infrastructure being a big one of those, but also the creation of an internal market, which the tax reform will do. So those things are seen as extremely important for international investors.
What about the perception of the government at this point? With the recent state elections, the Bihar elections, where the ruling BJP party has suffered a defeat, how are investors looking at that in terms of how it sets in with their position at the centre?
Well, that comes back to their expectation of reform. So if it is seen as this election result as to affect the pace of reform, then that is seen clearly negatively, and hence the reaction that we've seen in stock markets in the short term.
But do you think 1.5 years since the new government came into power, investors such as yourself are perhaps convinced that the government is on the right track? You may not have seen all the reforms in place as of now. A lot needs to be done. But has your perception of the government changed over the last 1.5 years from where it was when they came into power?
No, I think everything that has been said and the reform direction is absolutely right. But the question is, can it be implemented, and how difficult will it be to implement? And that, I think, is what we're all going to be watching into next year.
Okay, and finally, as you look into 2016, where do you spot opportunity? I mean, if I were to ask you your top 3 opportunities for 2016,
globally,
globally, yes. Globally. Where would you look at allocating capital, and where perhaps would you be looking at withdrawing money or booking profits?
Well, as we talked about, technology still offers plenty of interesting growth opportunities. So internet, mobile, online travel, those are all areas that we're very interested. Another area where we're very interested is oncology. So within healthcare, that's an area where we think there's lots of potential. And then another area is within Internet of Things, and the impact that can have on industrials. So those are 3 areas where we've got quite sort of good exposure, and that's companies really all over the world.
And within India?
Within India, I think if some of the valuations on some of the consumer stocks come down, plus healthcare, I think they could be more interesting for us too.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.